Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. In our last episode, we explored if one should trade penny options and the pros and cons of it. Today, I want to stick to options, index options particularly, and talk about a fascinating way of using options to limit drawdowns and participate in the upside of an index like Nifty. Such strategies are packaged as structured products or MLDs, market-linked debentures, and sold by wealth management firms to HNIs. Today, in this episode, I will teach you a DIY way of doing it. Fair warning, as interesting as this episode is going to be, it would need a fair bit of your attention to make sense of what I explain, plus some bit of understanding how options work. So get your coffee, I have got mine, and let's get started. By now, many of you would know I'm a fan of Taleb. If you haven't read the book Antifragile yet, maybe you should. The reason I'm bringing up Taleb again in this episode is because of the idea of optionality that is central to the book Antifragile and equally foundational to the strategy that we will discuss today. So what exactly is optionality? In textbook terms, optionality as Taleb defines is similar to an option, a right but not an obligation. The defining mathematical property of an option is that it is a non-linear way to be exposed to a source of variation. In simple words, you pay a small price, that is the premium, to participate in the upside, but on the downside, your loss is capped at that small price. It offers what is known as non-linear exposure. Heads I win, tails I don't lose much. This idea is at the heart of what we will discuss today in our Limited Downside Nifty Strategy. But before we go into the strategy, we would need to understand some definitions, context, historical and product-specific stuff. Let's get started. First things first, what exactly is a structured product or an MLD, market-linked debenture? Market-linked debentures or MLDs are hybrid financial products sold primarily to India's high-net-worth individuals, HNIs. They are designed to give investors better returns than fixed deposits by adding a chance for stock market returns while also offering protection against losses. An MLD is simply a combination of two things. First, a bond, a debt product, typically a high-yield debt security, usually a non-convertible debenture or NCD, issued by an NBFC, which is a finance company. This part is structured in a way to ensure that you get your original principal back at maturity, hence the term principal protection. Second, an index option, which is a derivative, a call option typically that is linked to an index like Nifty 50. A small part of the investment is used to buy this option, which gives the investor a share of any market upside. In short, if market rises, you get your principal back as the bond's minimum interest covers it, plus you get the upside from the option. Now, if the market falls, you still get your principal back, which is included in the bond's minimum interest, and nothing from the call option as it simply expires worthless. For example, a typical MLD would look like this. You invest 20 lakhs for about 2.5 years. About 90% of it, which is 18 lakhs, goes into a zero coupon NBFC debenture. It pays no periodic interest. 18 lakh grows to 20 lakh in 2.5 years, which is approximately 4.3% annually. This ensures full principal protection at maturity. The remaining 2 lakh is used to buy long-dated Nifty call options, also called LEAPs, which is long-term equity anticipation securities. This portion provides market-linked upside. If Nifty rises, the option gains value. If Nifty does not rise, the option may expire worthless. But your principal remains protected because of the debt portion. Typical upside structure that an MLD would promise is a bit like this. About 1.5x Nifty returns up to a cap, Scenario outcomes something like this. If Nifty rises 20%, you get roughly 30% on the total investment, about 26 lakh. If Nifty rises strongly, that is 35%ish, then your return is capped around 33%, about 26.6 lakhs. If Nifty falls, the option value becomes zero, you still receive your 20 lakhs back. In short, a structured product or an MLD is a bond layered with a derivative. While the bond would have credit risk, it does not have market risk, and the call option offers participation on the upside in an index. Here's a bit of background information of structured products and MLDs in India. You see, MLDs first appeared around 2006-2007 and grew in popularity, especially after the 2008 global financial crisis, as investors sought safety with some upside. But the Reserve Bank of India, RBI, the banking regulator, grew concerned about the complexity and the risk associated with structured derivatives. They were particularly worried about the mis-selling, as retail investors might not fully understand these complex products, and possible systemic risk through widespread offering of complex derivatives could pose a risk to the banking system. And therefore, in 2008, RBI restricted domestic banks from offering complex structured derivative products to retail investors. This effectively forced banks out of business of widely distributing these notes domestically. Since the RBI restricted banks, issuers had to find another legal channel. They found it in the non-banking financial companies, NBFCs as they're called. Now, NBFCs, which are regulated by RBI but under a different set of rules than banks, became the primary issuers of the debt portion of these products. Wealth management firms often set up their own NBFC subsidiaries to issue these market-linked debentures, MLDs, allowing the business to continue outside the banking system's stricter derivative restrictions. With increasing popularity of these products, SEBI stepped in 2011 and announced the guidelines for issue and listing of structured products or market-linked debentures. It also set a minimum net worth requirement of close to 100 crore plus for MLD issuers and mandated strict disclosure norms, example, scenario analysis, credit risk warning, etc. In Jan 2023, SEBI reduced the minimum face value of privately placed debt securities, including MLDs, from 10 lakh to 1 lakh to allow for wider participation. But the biggest impact came in April 2023 when Government of India changed the taxation status of MLDs. Gains are now taxed as short-term capital gains regardless of the holding period. This change significantly reduced the appeal of MLDs for HNI investors as the favorable long-term capital gains tax arbitrage was removed. Today, these products remain a niche HNI tool used for capital protection plus tactical equity exposure, though volumes have moderated post-tax change. Their future will depend on whether investors still value the asymmetric risk-return profile now that the tax arbitrage is gone. With the basics and the background sorted, let's now look at how to create a structured product the DIY way. First things first, a disclaimer. The mutual funds and index options referred to in the examples are only for illustrative purposes, and this is not a recommendation to invest in any of these products, including the index calls. Back to the example. In our illustration, the minimum capital required would be equal to the notional or contract value of Nifty at the time of initiation of the structure. For example, if you were to start the structure in Jan 2025, you would need a capital of approximately 18 lakhs, that is 24,000 Nifty spot value, multiplied by 75, that is the lot size. For the debt component of the structure, I would share three options with you. One is a simple liquid fund, next is a gilt fund, and the third a more riskier hybrid fund. Unlike an MLD where the debt component can be quite opaque, here you have full control on where you would want to invest. Back to the example of 18 lakhs. The first thing you would need to do is to buy a long-dated Nifty call option. Say in January 2025, the 24,000 Nifty call expiring in December 2025 would have costed you 1,980 rupees, and you multiply that with 75, that is the lot size, would come to 1.48 lakhs. The balance 16.52 lakhs would need to be invested in any of the debt or hybrid mutual funds that we choose. Also, to fully cover the cost of funding the Nifty call through the base investment, you may need approximately a 9% yield, in which case your downside risk at the end of the year would become zero. However, it's hard to find a safe and liquid pure debt product that would yield 9+%. Now for a moment, assume you get a yield of 6%, in which case your max drawdown becomes 3%. The upside would depend on the index move. If index closes above 24,000 plus the amount paid for the call option by the end of the December would be positive on the index call option. Let's look at how the strategy would have fared had we used liquid fund as the base since 2019. Here are the rules that are used for the backtest. 1. We invest on the first trading day of each calendar year, calculate returns up to the December call expiry, last Thursday or Tuesday that is. 2. Initial investment value would be Nifty spot on the day 1 multiplied by lot size, just the way we had discussed earlier. Point number 3, on day 1 we buy at the money December calls, strike rounded to nearest 1,000 for better liquidity. Point number 4, remaining capital initial value minus the call cost or the CE cost is invested at day 1 closing NAV in a liquid fund, a gilt fund or a conservative hybrid fund. Point number 5, on December CE expiry, we record the fund values based on NAV. Total portfolio value, that is call payoff plus the final fund value for each of the scenarios. 6. Max potential drawdown for all 3 scenarios is call premium minus the returns from liquid, gilt or hybrid funds. Their individual drawdowns are ignored in this working. 7. For Nifty B's comparison, we use closing price on entry and exit days. Nifty B's max drawdown is calculated using the daily closing prices. Now over to the table. In absolute terms, this strategy will underperform Nifty sometimes, but that's not the reason you should choose it or ignore it. Instead, look at the risk-adjusted returns. You take very little risk and yet participate in the upside of the index. Look at the potential max drawdown value. If you look at the table, the max it went to was 6.4% in 2022. It fully depends on the cost of the call option and the expected yield from the mutual fund investment. There will be some cases, especially with gilt funds and hybrid funds, which will fully cover the cost of the call options. Now look at the risk-adjusted returns column. You can see for yourself the impact of having debt as the base. You're taking very little risk and still participating in the upside. Now, obviously, liquid fund is just one way to do it. You can always choose a gilt fund or a hybrid fund as well. While it will alter the return profile, it still gives you a choice to aim for better returns. In this table, I have taken SBI Liquid Fund, ICICI Prudential Gilt Fund and SBI Conservative Hybrid Fund as examples. Here's a comparison across different mutual fund products using the same structure. Now look at 2019. While Nifty B's gave 12.9%, Gilt plus Nifty call combination outperformed at 14.4%, whereas Liquid Fund plus Nifty call option gave about 9.99%, not bad for a low risk investment. 2022 was bad across all structures, and in 2025, while in absolute terms all combinations underperformed, but if you look at it from a risk adjusted perspective, the portfolio would still look super stable. As I have mentioned earlier, the key here is not absolute returns. The key here is how risk is managed through this structure. The loss of returns is the price you would pay for a peaceful sleep. Now obviously it's not all hunky-dory, be it with DIY structure or an MLD. There are pros and cons to each of these, and here is what you need to know. Talking about the pros of a DIY structure, you have full choice and control in terms of where you want to invest the debt component. 2, there is no liquidity risk because you choose the debt component. 3, you can, if you wish, pledge your mutual fund and layer more strategies for better returns, but in that case, it would also increase the risk. And there are no lock-ins when it comes to your own DIY structure. Cons of a DIY structure are you would have to execute the trades every year and the minimum ticket is quite high. And yes, it may underperform a traditional MLD sometimes. Now, talking about the positives of an MLD, the biggest one is the small ticket size. The second is no execution effort required because someone else would do it for you. Talking about the downside of an MLD, there is obviously the biggest risk, which is credit and liquidity risk. And you don't get a choice in terms of the quality of credit in which you invest. And that's a big risk. Then we have a lock-in with a premature exit fee. So it's not as free as a DIY option. And then if you are an MLD investor, the investment cannot be pledged if you want to use your capital for any other purposes. So essentially your capital efficiency could reduce. And lastly, while earlier MLDs had a tax advantage, that no longer applies today. In summary, if you are an active investor and would like to geek out on structuring portfolios, the ideas shared in this video are a good starting point. Once you understand this dual layer design, you can now play with both the components. You can choose to go OTM with calls to reduce cost basis. You can also choose to create other option spreads depending on your reading of the markets. Sometimes you can choose to time your call buy based on specific market reference. Say you would buy the call only if markets correct 10%. Likewise, as we had shown, you can also play around with the underlying. By investing in different category of funds, you can fine-tune the risk-return profile of the larger portfolio. The possibilities are many, with your imagination being the only limiting factor. If you have more such ideas to structure portfolios, do share them with me in the comments. So that brings us to the end of this deep dive on DIY structured products and MLDs. I hope you found this episode valuable, and do share your questions, thoughts and feedback in the comments. I'll do my best to answer them. Thank you for watching and see you in the next one.